The US economy is barreling towards a recession. That's what they say, at least. You came here for the truth, so let me unveil that for you. All of these distractions, everything that's happening today pales in comparison to some information I'm going to show you right now. Let's begin by taking a look at this article that highlights, oh my goodness, a recession is coming, a recession is near. Look at the jobs numbers, look at these numbers, look at the distraction, the shiny object in front of your eyes, and ignore everything else. Not on this channel. I'll show you the real deal. Look, Treasury yields jump on the prospect of US having to refund tariff money. 30-year yield tops 4.9%, 4.97%. It has gone higher. Gold has gone higher than what I show you. This thing is just evolving so fast, I can't even keep track of it all. The point is that this is going up. It's supposed to go down. Right now, they're cutting interest rates. The yields are supposed to go down. And yet, everything, all countries, not just the US, they are pulling in the opposite direction. Have we forgotten that these countries, all of them, printed trillions upon trillions upon trillions of dollars, devaluing their currencies into nothingness? And so you're expecting the markets to work, to be functional? Isn't that crazy? Well, that's what's happening here. So let me go a little bit further. Gold futures rise to a record high on Fed concerns and rate cut expectations. The precious metal is now up more than 34% in the year to date. The barbarous relic, as they say, is up 34%. I was told by a person who manages a lot of money that gold would not go higher than 1500. This is in the previous part of the cycle. It wouldn't go higher than 1500. Gold was useless. Gold wouldn't do anything for you. Well, unfortunately, for those people that get their money managed by this guy, they should have had a small percentage of that portfolio in gold. And that would have been able to preserve some wealth. They could pass it down to generations. These are older people. And instead, what they did was they had something that this company could make fees on. You get it? You see why? Yeah. Okay, you're looking at gold. It goes above 3,500. It goes even further, on and on. By the time you're watching this, who knows where it is. Now, I don't like it when it goes up so high so fast. That's never a good thing. You see the same thing with oil. You see the same thing with other commodities as well. It always goes ballistic and then it will come down super fast. Not healthy. However, right now it is at a record high and there is always going to be these different concerns which can push it higher and higher and higher. If only we could see some sense of stability, and that would give gold a sort of, this backing off. You would see that. What is the hidden thing, though? What are we not talking about? What is the elephant in the room, you ask? Well, I'm going to show you that right now. You made it this far in the video. My goodness, 4 minutes. Some people can't even make it that far. The Federal Reserve's multi-year process of shrinking its balance sheet, which now stands at $6.6 trillion, might soon need to end if liquidity becomes more scarce. This is where we get into it. I want to explain it all. I'll try to do it as simple as possible. I have something called the money mirror method. I've discussed it here on the channel. I highlight it frequently on the Finance Friday. The money mirror method looks at different measurements of liquidity to understand where the markets will go. And it goes out of flux occasionally and it gets all wacky and comes right back in. What do you need to know? You can go to a search engine and type in Fed net liquidity. And this is a sort of like a basket. And that makes up the total amount of liquidity that's out there. And when we look at this, this has a direct impact on asset prices. And the problem that we have today is that you have a balance sheet that's shrinking, QT, quantitative tightening, at a time in which stocks continue to escalate. This puts them at odds with each other. Look, Congress in July raised the US debt ceiling by $5 trillion, allowing the government to increase borrowing in the bond market and to refill the US Treasury's general account at the Fed. I heard from individuals that they have to get the debt down. You've probably heard that as well. I had a financial advisor tell me that. They're making some really good moves there in the US. They're getting the debt handled. Are they? Is the US getting the debt handled? Really? I don't think so. And I don't think any other country will either. As the Treasury's account balance has grown this summer, demand for the Fed's overnight reverse repo facility has fallen. These are all part of the money mirror method, okay? The Fed keeps tabs on use of the overnight reverse repo facility because it helps gauge the amount of extra cash sloshing around in the markets. I found it funny. My Finance Friday crew will find it funny that they use the word sloshing around, which is something I tend to use when I talk about this. It also can help keep short-term interest rates in check. The facility has been trending towards a $0 balance and could flatline any day. If you want to get a reference here, it was at $2.2 to $2.3 trillion at one point, every single day. Now it's near zero. Use of the facility has fallen as US money market funds have instead piled into the deluge of new short-term treasury bills auctioned by the government since July. So money needs to go somewhere super short-term, overnight. And this is the way that instead of keeping cash, they can have something. And it makes like a small percent, small little bit of interest. But you do it every single day, and of course that accumulates, and that's how they make a little bit of cash. Well, the Fed rate cuts in September, potentially, and threats to the Fed's independence have been in the spotlight. You've heard that. But that might be overshadowing the central bank's renewed focus this summer on its balance sheet, market liquidity, and getting to a comfortable level of bank reserves without going too far. This is super important. I'm really trying to spend a lot of time on this so that we can all understand it. Banking reserves currently sit around 3.3 trillion, which is above 2.7 trillion. That's the Fed Governor Waller saying would be the lowest comfortable level. So you can only get those to come down so far. And then at that point, you have what happened back in 2018. Janet Yellen was at the helm at that time. And unfortunately, the market started to tumble. 2019, there were problems. Okay? Looking at this. Basically what they're saying is they are trying to get their balance sheet quantitative tightening. There have been, and it says it right here actually, they dramatically slowed their balance sheet runoff back in March. So it was going down, then it starts leveling off. Now it's at very minimal, and then they'll stop it right there. So that's it. Your currency, all that devaluation, it isn't going away. All the debt that's been accumulated, it isn't going away. What do we do if this is the case? Is it so obvious to those who have been paying attention? I hope so. It is a devaluation of the currency. Your currency is being devalued significantly. That means assets. And people say, well, I'll just buy AI stocks. But look at instances, Weimar Germany. Look at others, but look at times when you have super high inflation. And even during the 70s, by the way, very high inflation, stocks were not good, depending on the years you're looking at. Stocks were not good. So we need real assets. We need to be super careful about the advice that we're taking from these very inexperienced individuals across YouTube. This is a very dangerous thing because they've never seen a crisis. Imagine that. How could they ever be prepared? Of course they can't. They're certainly making money though. For the American middle class, it's been a summer of cooling confidence. Consumer sentiment dropped. You're looking at people that are making supposedly enough cash. They're making in the six figures, but they can't pay their bills. They're dealing with problems, many problems. And you say, well, you know what? They're spending. Their spending is the problem. That might be the case, but things are getting real expensive. Manufacturing activity contracts for the 6th straight month. It's survival. This is manufacturing. I thought the jobs were coming back. There's so much uncertainty. I myself tried to get some manufacturing to happen. I tried. I contacted many different factories, and it seems to be, I'm still going to try, so far actually impossible to manufacture what I need to be made for my other business. That's not good. That's not healthy. US stocks are now pricier than they were in the dot-com era. S&P 500 has never been this expensive or more concentrated in fewer companies. Big problems. Bad. And in the long term, you can see the Shanghai Cooperation Organization, also known as the SCO, they met. They basically said, let's get together. Let's be friendly. Let's do more things. They do military drills. They do all this kind of stuff, right? Okay, so remember, for you, what do we need to pay attention to? This right here explains long term, there are some very big trends. Very big trends. And if you're not paying attention, you're not going to see it. The money is moving towards the east. There's no question. And so you got to be aware of that. You're seeing real assets going up. You're seeing quantitative tightening. What's next? What's next? It's the quantitative easing. It's the rate cuts. They're going to pile on in, and real assets are going to see the benefit of it. We're seeing a lot of weakness in other places. There could be deflation in some places. Be very careful. You have to have a backup plan. You have to have a way to be able to make money when basically the stock market could be down, your retirement account could be down, you have a 401k, an RRSP, a super, these things are getting hurt. You can still make money. That could be done through many means. It could be done through an online business. It could be done through a physical in-person business. Whatever that case is, some of these places do real well, even in a recession. Okay, and you could look at fixed income. You could get into certain things. People, I would be very careful. There's companies like FTX who would say, oh, don't worry, leave your cryptos with us and we'll give you this very high rate of interest. Oh, by the way, never leave your coins on the exchanges. We found out the hard way, right? But those YouTubers definitely took the money though. Anyway, I wanted to tell you that I have this thing called the Finance Friday, and basically when you get in there, you'll learn the depths of everything. If you want to try it out, okay, just come on in. I have 2 emails in my inbox right now. Got to reply to those people. They want to try it before they buy it. Absolutely, 100%. Join us on the Finance Friday. I'd love to see you there. To support the channel, hit that thumbs up button. Not just now, but on all the videos. Just click that one button. It's 2 seconds. That really helps me out. And you just put a comment in there if you can. That also, all the engagement helps this channel. And, I hope that you found it informative. I hope that this was something that piqued your interest. And I'll see you on the next one. Take care.